You need to know these 5 critical tax tips before filing your tax return on April 15th. Now this applies to anyone, individual, small business owner. You've got to know these 5 because they impact you and the amount of money you're sending to the IRS or keeping in your pocket. I'm Matt Sorensen. Let's build wealth. Now the first thing I want you to think about on April 15th is whether even to file by April 15th. Maybe you file an extension. Actually, that's what most wealthy people do. What most of our clients do is they file an extension, giving you until October 15th to file. There's a number of reasons why I want you to think about filing an extension and not stressing about April 15th. First, it's free. It's Form 4868 with the IRS. There's no fee. You can get an extension from the IRS. Second, it gives you more time to properly plan, to find those deductions, to be prepared, and to have an accurate tax return. Third, you have less chance of an audit. It's surprising. A lot of people think if I don't file on time by April 15th, I'll probably get audited. It's the opposite. There are more audits on a percentage basis for those that file between January and April 15th than those that file using an extension. So you decrease your chances of an audit by filing an extension. And the final point here is the extension to file, giving you until October 15th, is not an extension to pay. You still need to make payment of the tax by April 15th. Well, if I haven't filed my return, how much tax do I pay, Matt? Well, what I want you to do is look at your prior year tax return, look at how much you owed to the IRS and to the state, and then make an estimated payment on what you paid based on last year's numbers. If you're about the same, pay in about the same. If you're maybe 50% higher or lower, maybe ratchet up your tax up by that 50% threshold. Just an approximation here. You don't have to nail it exactly, but you do need to still make a payment of the tax by April 15th. Now, the second tip here is critical. This is where most people lose their tax deductions because they have not properly tracked. You have a side hustle. You drove Uber, you're a consultant, you're a real estate agent. Maybe you've got a rental property, short-term or long-term. Are you tracking all of those expenses? Did you track your mileage, your travel, the conferences you went to, the education, your laptop, your health insurance payments, which are now deductible? Did you track your business meals, your cell phone, any equipment you bought, the camera, all these things that you're using in your business, in your side hustle, or at your rental property? Did you get all those expenses? So many small business owners and real estate investors miss these things because they are not properly tracking it, and they rush to file by April 15th. Again, a good reason to extend. Make sure you capture all these deductions, and a good reminder to be organized for next year. All right, now the third tip applies to everyone because this is a question whether you're a W-2 employee or self-employed. You've got to decide on your 1040, and this is whether to take the standard deduction or whether to take itemized deductions. Now, basically what the standard deduction is the IRS said, you know what? Don't track all your mortgage interest, charitable deductions, and all these other things. We're just gonna give you a standard deduction everyone gets to take. And if you're single, that number is $14,600. If you're married, it's $29,200. Now, how a standard deduction works is let's say you're single making 100 grand a year, you take a $14,600 deduction. That means your taxable income isn't 100 grand, it's $85,400. You get that $14,600 as an immediate deduction, and you're only taxed on the $85,400. Now, 90% of people just take the standard deduction, but I want to make sure you're not missing the opportunity to itemize and get more deductions. Here are the primary deductions you will take if you're itemizing. Now, if these go over $14,600 single or $29,200 married, you want to itemize. You'll get more deductions. Here's the most common itemized deductions: mortgage interest, charitable deductions, state and local tax. There's more you can take, but those are the primary 3. Now just think, if you have a $600,000 mortgage at 7% interest, you're paying $42,000 in mortgage interest in your first year. If you're single and not taking that, you are losing $30,000 in mortgage interest that could be a deduction on your tax return. So let's just go through a quick example here. Let's say you make $150,000 a year married, okay? And you're saying, well, I could just take a $29,200 tax deduction. All right, well, that'd be stupid. Don't take the standard deduction, because if you itemized, let's say you had that $600,000 mortgage at 7% interest. All right, that's $42,000 right there in mortgage interest. Let's say you paid $8,000 in state income tax because you're in a state that has state income tax. And if you're in a state that doesn't have state income tax, maybe like Texas or another state, you get to take the property tax that's high, okay? And right now that maxes out at 10. Let's say in this example you had $8,000 of state income tax. Okay, now we're at $50,000 in deductions. And maybe you gave 10% of your income to your church or charity. charity. There's another $15,000. So now I'm up to $65,000 in itemized deductions as opposed to just taking $29,200. So make sure you are not missing the opportunity to take the itemized deduction. I know a lot of people, they're doing TurboTax or doing their own return, and it's so easy to just hit the standard deduction button. No, go track these other deductions. For many of you, particularly if you're a homeowner or you're someone that gives to your church or charity, you will save by itemizing your tax deductions. Right, now the fourth tip, probably one of my favorites, is putting your money into an IRA. Even though we're in 2025, you actually have until April 15th of 2025 to make 2024 IRA contributions. You can put $7,000 into a traditional IRA or a Roth IRA. And if you're 50 or older, you can do $8,000 a year. You're married, you and your spouse could do this. Maybe you have a business your kids work in, you could do kids IRAs or kids Roth IRAs, okay? Even your health savings account contribution isn't due until April 15th. So we have a lot of time to put money in still to our IRAs or HSAs and get a tax deduction, saving us taxes on our 2024 tax return. Now, keep in mind, if you file the extension I talked about earlier, that does not give you more time to make these IRA contributions. You still need to get them in by April 15th. But this strategy isn't just cool now if you're doing traditional contributions, taking a deduction on your return. This is a way you're building tax advantage wealth for the long haul. Money in your IRAs grows and you don't pay tax on the income and the gains you're having as you're building up that account. So it's a tax advantage way to build long-term wealth. Also, it's asset protected. You can file bankruptcy and keep the money in your IRAs or 401ks. So don't miss out on that strategy. Great tax planning, long-term wealth building. It's also a great asset protection tool. And the last tip here is the best tax planning happens in the year when you are earning the income. If you want to do 2024 tax planning, you should have that done by December 31st, 2024. There's some of these things I mentioned here we can still do by April 15th and making sure you're getting the right stuff on your tax return. But in many ways, you're kind of like a historian doing your tax return on April 15th. You're reporting what already happened and there's not much you can do besides some of the things I mentioned here. Good tax planning. The people that truly save on tax get the tax planning done in the tax year and make all their moves before December 31st of the tax year. So make sure you get with your CPA, your tax advisor. Our law firm KQS Lawyers helps clients around the country doing business and tax planning to make sure they're keeping more money in their pocket. Now, I hope these tips save you money when you're filing your tax return and at least make you more confident as you're doing that. Please subscribe to my channel though. I've got a lot of tips on saving on taxes, protecting your assets, and building wealth. I'm Matt Sorensen. We'll see you next time.